SpaceX just filed for the largest IPO in the history of financial markets. And the moment that happened, a $350 billion machine switched on, and that machine is pointed directly at the stocks sitting inside your retirement account right now. This is not a theory. This is not a prediction. This is arithmetic, and arithmetic does not care about your feelings, your optimism, your financial advisor's reassurances, or the fact that your S&P 500 fund has been going up for the last 3 years. The music is stopping. The chairs are being removed. And if you are not paying attention right now, you will be left standing. If you are not subscribed to this channel, you are making a decision that will cost you. The analysis I'm about to give you is the same caliber of thinking that institutional desks charge millions of dollars a year to access, and you are getting it here right now, completely free. All I ask is that you hit the subscribe button before this video is over, because the next video I put out could be the one that changes the entire trajectory of your financial life, and I refuse to let you miss it because you forgot to click a button. Here is what most retail investors fundamentally do not understand about how capital markets actually function. And this ignorance is not their fault, because the financial industry profits enormously from keeping you in the dark about the basic mechanics of where money comes from and where it goes. When a company like SpaceX goes public and says it needs $75 billion, that $75 billion does not materialize from the sky. It does not come from some magical pool of new capital that suddenly appears in the universe. It comes from existing investors, meaning fund managers, pension funds, sovereign wealth funds, and institutional allocators who are currently holding stocks that you probably own, liquidating those positions to free up the cash to buy into the IPO. That is the mechanism. It is that simple, and it is that brutal. Now add OpenAI at $60 billion, add Anthropic at $60 billion. You are now looking at the $195 billion that has to be pulled out of existing markets in a compressed window of a few months. And when you ask the obvious question, which stocks do the big funds sell first when they need to raise cash quickly? The answer is always the same. They sell the most liquid names they own. They sell the ones they can exit fastest without moving the market too violently against themselves. And those names are Google, Nvidia, Apple, Microsoft, Amazon, Meta, Broadmark, AMD, Tesla, and the rest of the top 10 in the S&P 500. The exact same 10 stocks that have generated 72% of all S&P 500 gains this year, not 30%, not 50%, 72% of all your gains this year came from 10 companies. And those 10 companies are precisely the ones that are about to get sold by the biggest funds in the world to finance the 3 largest IPOs in the history of capital markets, all arriving simultaneously. I want you to sit with that number for a moment. $350 billion being extracted from the market in a matter of months. To give you a sense of scale, the entire GDP of South Africa is roughly $400 billion. We are talking about nearly an entire nation's annual economic output being pulled out of the equity markets and redistributed into new listings in a very short period of time. And not a single anchor on financial television is connecting these dots for you in plain language, because plain language is bad for the brokerage commissions that pay for the commercials that pay for their salaries. I have no such conflict. So I am telling you directly, the $350 billion has to come from somewhere, and it is coming from the portfolio you have spent years building. Now let us talk about the second force, because the IPO wave alone would be damaging enough. But what the large technology companies are doing simultaneously makes the entire situation significantly worse. And it is something most investors do not fully understand, even when it is explained to them, because the mathematics of dilution are psychologically uncomfortable to accept. Google, formerly known as Alphabet, has just announced the largest single stock offering in the history of the technology sector. They are issuing $85 billion in brand new shares. I want you to understand precisely what that means, because the phrase issuing new shares sounds bureaucratic and distant, like something that happens in a boardroom that has nothing to do with your account balance. It has everything to do with your account balance. When Google issues $85 billion in new shares, they are not growing the company. They are not adding $85 billion worth of new assets, new revenue, or new profit to justify the new shares. They are simply printing more certificates of ownership in the same existing business. The pie does not get bigger. The pie gets cut into more slices, and your slice, the one you paid full market price for, shrinks. That is not an opinion. That is basic mathematics. If there are 12 billion shares outstanding today, and Google prints another 700 million, you now own a smaller percentage of the same company than you did yesterday, and you were never asked, never warned, and never compensated. And it is not just Google. Meta is reportedly preparing to do the same thing. And when that rumor surfaced, Meta's stock dropped between 5 and 9% in a single trading session, which tells you everything you need to know about how the market interprets this kind of action. Microsoft is spending close to $200 billion on artificial intelligence infrastructure this year. You do not spend $200 billion without eventually having to find that capital somewhere. And when the debt markets are already saturated, the stock market becomes the ATM. Amazon is in the same position. These are not four separate stories. This is one story. The largest technology companies in the world are all simultaneously turning to the equity markets to fund an AI arms race, and they are funding it with your ownership stake. The debt channel explanation matters here because many people ask why these companies do not simply borrow the money. The answer is that the debt markets are already choking in just the first 5 months of this year. AI-related companies issued $110 billion in debt. Lending costs have risen. The institutional appetite for additional tech debt has limits, and those limits are being reached. So the path of least resistance becomes share issuance. You print stock, you dump it on the public markets, the public absorbs it, and you walk away with the cash. The dilution is real. It is immediate, and it is mathematically guaranteed to reduce the value of what you already hold. All else being equal. Now I want to talk about the third force, because this is the one that operates in total silence, the one that happens automatically inside the funds you trust most, the one that carries the clinical name of index rebalancing, but which functions in practice as a mechanism that sells your winners without your knowledge or consent. So the NASDAQ has a rule called the fast entry provision. Under this rule, when a company that is large enough goes public and qualifies for inclusion in the NASDAQ 100, it can be added to that index in as few as 15 trading days. And every index fund, every ETF, every target date retirement fund that tracks the NASDAQ 100 is then mechanically required to buy shares of that new entrant. This is not a discretionary decision. It is automatic. It is algorithmic. It happens whether any individual fund manager thinks it is a good idea or not. But here is the part that should make your stomach drop. These funds do not hold cash reserves large enough to simply buy the new position. They have to generate the cash to make the purchase. And they do that by selling their existing holdings across the board. When SpaceX gets added to the index, every NASDAQ 100 fund in the world sells a proportional slice of every current holding. Microsoft, Nvidia, Apple, Google, every single name, to make room. Estimates on the forced buying pressure for SpaceX alone, run between $15 billion and $30 billion, depending on the methodology. Then OpenAI goes public. The same mechanism triggers again another round of forced selling across all your existing holdings. Then Anthropic goes public. Third round, 3 separate mechanical events, all targeting the same 100 stocks, all occurring within a compressed time frame, all completely invisible to the average investor sitting in their 401 kilobits looking at a number on a screen. And I want to be absolutely precise about the concentration problem here, because it is the foundation on which everything else rests. If you own an S&P 500 index fund, which the majority of Americans do through their workplace retirement accounts, you believe you are diversified across 500 companies. That is what the product was sold to you as. That is the fundamental promise of the index. But take your total balance in that fund and multiply it by 0.4. And that number tells you how much of your money is concentrated in just 10 stocks. If you have $200,000 in an S&P 500 index fund, $80,000 of that money is riding on 10 companies. And those 10 companies represent the precise intersection of all 3 forces I've just described to you: the IPO liquidity drain, the dilution wave, and the mechanical rebalancing pressure. You are not diversified. You are concentrated in the most targeted corner of the market at the worst possible moment for that concentration. Monish Pabrai, one of the most disciplined value investors alive, and a man who studied directly under the framework that Charlie Munger built, was asked recently about his view on the S&P 500. His answer was a single word: bearish. Not cautiously optimistic, not neutral, bearish, and he has zero allocation to large cap technology stocks. Warren Buffett's Berkshire Hathaway, the organization that has spent decades publicly advocating for ordinary investors to simply buy and hold the index, has sold its own S&P 500 index fund position when the 2 most celebrated long-term investors in the history of American markets both exit the same vehicle they once endorsed. The intellectually honest response is not to dismiss that signal. The intellectually honest response is to ask what they know that you do not. I have been watching markets long enough to know that every cycle rhymes. The names change, the technologies change, the specific catalysts change, but the underlying human psychology and the mechanical structure of how capital flows through markets repeat themselves with remarkable consistency. And if you understand that pattern, you can navigate it. If you do not, you become the exit liquidity for the people who do. Let me show you the pattern clearly so that you recognize exactly where we are in the current cycle. In 2021, the conditions were nearly identical to what we are experiencing now. Money was cheap. Enthusiasm was at historic highs. The IPO market was exploding with new listings at valuations that could only be justified if you believe growth would continue indefinitely at rates that no company in history has ever sustained. Rivian went public at a valuation that exceeded Ford and General Motors combined, despite having delivered almost no vehicles. Coinbase went public at the peak of a crypto mania. Robinhood went public on the premise that a generation of new retail investors would trade forever at the volumes they were trading at during lockdown, and the retail public, told by every financial media outlet that this was the new normal, bought in. Then the Federal Reserve began tightening. Interest rates moved up, the cost of money rose, the marginal buyer of speculative assets disappeared. Rivian fell 85%, Coinbase fell over 75%, Robinhood fell 85%. The IPO market did not slow down. It collapsed entirely for nearly 2 years. The pattern has 4 stages, and they always arrive in the same sequence. First comes the hype, the narrative that this time is different, that this technology or this company or this moment represents a permanent shift in how the world works, and that normal valuation rules do not apply. Second comes the IPO flood, the moment when every private company that has been sitting on inflated paper valuations decides that now is the time to convert that paper into real cash by selling to the public. Third comes the liquidity drain, as the capital required to absorb all of those new listings gets pulled out of the existing market, tightening the system and removing the fuel that has been driving prices higher. And fourth comes the repricing, which the financial press calls a correction and which everyone else calls losing money. We are currently sitting at the border between stage 2 and stage 3. The flood has begun. SpaceX, OpenAI, Anthropic, Google's share issuance, Meta's reported issuance, these are all stage 2 events. The liquidity drain is beginning, and Tom Lee, who I want you to understand is not a pessimist, is not a perma-bear, is not someone who makes a career out of warning people about danger. Tom Lee is the single most consistently bullish institutional voice on Wall Street over the last 3 years. He called the 2023 rally when consensus was expecting a recession. He called 2024. He called 2025. This is the man who has been correct about the upside more reliably than almost anyone else. And right now, he is warning of a 20% correction in the middle of this year, driven by Federal Reserve leadership uncertainty, AI valuation repricing, and policy fragmentation from ongoing trade conflicts. When the most optimistic, credible voice in the room starts telling you to brace for impact, you brace for impact. You do not debate it. You do not look for a more comforting second opinion. You act. Now, I am going to give you the framework, and I want to be direct with you about what this framework is and is not. It is not financial advice. I am not your registered investment advisor. What I am is someone who has spent decades studying how capital actually moves through systems, who has sat with some of the greatest allocators of the 20th and 21st centuries, and who is giving you his honest, unfiltered assessment of the situation and a logical framework for thinking through your own response to it. What you do with this information is your responsibility, but the framework itself is rational, it is mathematical, and it is actionable today. The first thing you need to do is audit your actual concentration, and you need to do it today, not this weekend, not after you finish this video and check social media. Today, pull up your 401 kilobits, your Roth IRA, your brokerage account, every account where you hold investments, find the total dollar amount you have in S&P 500 or NASDAQ index funds, multiply that number by 0.4. That result is how much of your money is sitting in 10 stocks. Write that number down, look at it, and then separately, look at whether you also own any of those same 10 companies as individual positions, because many people who own index funds also own Apple, Google, or Nvidia separately, convinced they are expressing a specific view while not realizing they are doubling down on the same concentration they already have inside the index. You need to know your real number before you can make any rational decision about what to do. Next, the second step is understanding where capital rotates when it leaves large cap technology, because the money does not vanish when it leaves those positions. Money in financial markets is almost never destroyed. It moves. It finds the next place where the risk-reward relationship is more favorable. And right now, the smart institutional money has been quietly rotating into sectors that most retail investors have ignored entirely because they are not exciting. Energy companies, both traditional fossil fuel and the infrastructure around the energy transition, have been performing. Coal and oil services have had extended periods of strength that received almost no coverage in mainstream financial media, transportation infrastructure, basic materials, and select areas of biotech, where valuations have been compressed for years and where the underlying science has continued to advance independent of the narrative cycle. These are the sectors where disciplined money has been building positions. I am not telling you to buy any of these specifically. I am telling you to understand that when large cap tech sells off, capital does not sit in cash forever, and identifying where it goes is more important than predicting the precise timing of when it leaves. The third step is the most important one, and it is the one that separates the investors who come out of periods like this wealthier from the ones who come out of them damaged. You build your watch list before the dip happens, not during it and not after. When markets are falling and every headline is catastrophic and every commentator is extrapolating the decline forward to infinity, the human brain is physiologically incapable of making good long-term capital allocation decisions. The fear response is too powerful. The loss aversion circuitry takes over. So people who had every intention of buying high-quality companies at lower prices find themselves paralyzed, or worse, selling into the decline alongside everyone else, which is precisely the opposite of what creates wealth. The solution is to do your thinking now while you are calm, while the analysis is purely analytical rather than emotional. Make a list of 15 to 20 high-quality businesses, companies with real earnings, real competitive advantages, real balance sheet strength that you would genuinely want to own for the next decade if you could buy them at a meaningful discount to where they trade today. Assign each one a target price that represents a genuine margin of safety. Then when the decline comes, and based on everything I have just shown you, I believe a meaningful decline is coming. You do not make any decisions. The decisions have already been made. You simply execute the plan you built when you were thinking clearly. That is not a trading strategy. That is discipline, and discipline compounded over decades is what actually builds wealth. Panic does not build wealth. Discipline does. The AI revolution is real. I am not standing here telling you that artificial intelligence is a hoax or that SpaceX does not represent a genuine transformation in what human civilization can do. I believe in the long-term transformative power of these technologies as deeply as anyone. What I am telling you is that the stocks are currently pricing in that transformation are doing so at valuation multiples that assume everything goes perfectly, that the capital being spent generates the returns being projected, that the timeline for monetization is the one the companies are advertising, and that no unexpected competition, regulatory friction, or technological disruption disrupts the path. The S&P 500 is currently trading at a price-to-earnings ratio of approximately 30, and the long-term historical average is 16. Stocks are roughly twice as expensive as normal. That was true in 2000 as well, right before a decade of near-zero returns for index investors. I am not predicting a repeat of 2000. I am telling you that when the most expensive assets in the most concentrated index in history become the target of a $350 billion liquidity extraction event, the mathematics of what happens next are not complicated. I want to leave you with something that has stayed with me through every major market dislocation I have lived through and studied. The people who build lasting wealth from periods of market stress are never the ones who are the most optimistic. At the top, they are the ones who did the uncomfortable work of looking honestly at the situation when it was still early enough to matter, who resisted the social pressure to join the consensus, and who had a specific mathematical plan ready to execute when the opportunity arrived. Every great bull market in history has had a significant shakeout inside it. The 1990s had one. The 2010s had one. This one will have one too. The question in front of you right now is not whether you believe me. The question is whether you are going to sit down today, run the concentration audit, understand where your money actually is, and begin building the plan that positions you to buy the hangover instead of the hype. Mohnish Pabrai sees what is coming. Tom Lee sees it. Buffett has already acted on it. The information is in front of you. What you do with it is entirely up to you. I will not be here to help you explain it away, but I will be here when you are ready to do the work. If this has given you something real to think about, share it with someone whose financial future you actually care about, because the most expensive thing in the world is information that arrives too late.